Well over 90% of traders that set out to be profitable end up unprofitable by the end of their journey. This is common knowledge among the trading community, and yet among those unprofitable traders, there are still so many similarities in how they trade. One of the biggest is using common patterns to find trading setups, which I believe to be one of the biggest root causes of why so many traders are unprofitable today. My name is Andrew Rader, but you can call me Rader. Today, my goal is to show you guys the logical cracks in pattern trading, but also how ineffective they actually are. Additionally, this wouldn't be beneficial unless if I offered a better perspective, which I believe I have. And I only have it because I got lucky. From a young age, I was mentored by a professional group of traders that taught me a profitable trading system, a perspective that I call today market mechanics. So without further ado, why shouldn't you trade patterns? By far, one of the biggest problems with pattern trading is that it encourages you to trade based off how the market looks rather than how it actually functions. And to help illustrate this in your brain, I love using this analogy. I'm a trader, and there's always a different market condition coming across my desk, and it's my job to solve that market condition, solve that problem, and if I do, I get rewarded with a profit. And traders are oddly similar to, well, car mechanics. Any good mechanic, whether you bring in a truck, a Corvette, or a Mustang, understands that you cannot repair a car just by its look. You have to understand the core similarities between them, the mechanics, how they actually work, right? If I'm a good mechanic, or if I'm a good trader, I understand that in every market condition, or every car, there's four wheels, there's an engine, there's a transmission of some sorts, there's an exhaust. While there's tiny differences between them, as long as I understand the big bulk concepts, the mechanics of them, how they actually work, I'm able to solve the problem. And you might ask, well, how does that relate to patterns? Well, think about it. If there's always a different market condition, every head and shoulders that you look for, the shoulders, head, and shoulders is theoretically different. They're not always the same. They're in a different context. They're always in a different location, a different atmosphere than they were in the previous one. But the core mechanics under them don't change at all. So why not just focus on that? So maybe you're not a car guy and maybe you're still confused. That's okay, because let me pull it up on a chart and maybe you'll start to see where these patterns fall apart. On screen now is a pattern that many look to: double tops and triple tops. Triple top right here. You have a 1 touch of the zone, 2 touch of the zone, and 3 touch of the zone. Logic says that on any breakdown, you should start to short maybe the neckline or something like right here to catch a bigger move down, right? Or at least that's what patterns tell you. Short what the market looks like, right? So you being the pattern trader, you wait for your entry patiently. Boom, right there. I'll take a short right there. I broke the neckline, or at least this recent low here. I'm going to take a short. It is a triple top after all, right? So I'm going to take a short and, well, what happened? Oh God, this really did hit my stop loss, didn't it? What happened was you didn't understand the mechanics of the market. You didn't understand how rotations work. And to put this in better perspective, let me put the SPY up here. This purple line right here is the SPY, and this stock I'm showing you is XLP. It's a consumer staple. It's like Walmart, Target, these type of names. They're known as what's called defensive. Typically, they thrive when markets start to sell off. Did you know that the markets were actually rotating into defensive names and out of technology and growth? We were near the topping cycle of the market, the final rotations. So shorting here would be absolutely silly, right? Because you would be shorting the strongest names. And you can see that as the SPY, the overall market started to keel over, this started to go up and up and up. And if you would have known these rotations, this was actually a better long than short all along. And even what people would call maybe a head and shoulders right here, right? You would have maybe looked at this and said, there's the shoulder, there's the head, and there's the second shoulder. And as you started to sell off, you might have started to enter on this candle to the downside, but you didn't know the rotations. And you didn't know that the defensive stocks tend to outperform when markets are starting to sell off in their topping cycle. What I'm trying to get you to see here is that even though we were presented with the triple top and even arguably a head and shoulders after, it was not a good idea to short that all along throughout that. And if you understood market mechanics in reference to how they actually work, not referencing the mechanics working on the cars, but the mechanics, the gears turning in the market, understanding that principle of relative strength, that once markets start to rotate into defensives and out of growth, they're likely to continue to do well. And until you see that start to slow down, you should not be shorting. But that behind the scenes is what a lot of pattern traders don't look at. They don't look to see how the market actually works to then justify their actions. They're just pointing and looking and saying, that's a good setup right there, but they're not going behind the curtains and seeing what's actually going on. So let's take a look at another example, this time on what appears to be some sort of bear flag. Well, you've had this massive drop, you start to come down and form some sort of parallel against trend. That is a classic bear flag pattern. The question is, do you long or short here? And well, the answer is it's likely to go down, but the better trade is long. Wait, What? The markets after that point did continue to drop, but that wasn't the best risk to reward trade. That wasn't actually going to be the trade that printed the most money. How do we know that? Well, we know the mechanics of the market. And part of the mechanics of the market is understanding how the options market influences the equity market. And that this put order right here, this built a support level. This one order, not on the chart, nothing that you could have discovered on the price action. This one order behind the scenes printed an absolutely strong support and ultimately the bottom for the stock into the 16th. This order right here placed 1.46 million at 145 strike. This guy bought 2 weeks out. He bought on the 2nd. Check this out. As soon as he bought on the 2nd, it tanked in his favor, but as you started to drop lower into that 145, around that area, you built a support. They could not let this guy go in the money. They couldn't pay him out. He created such a big imbalance that this big put order, again, betting on the downside of this stock, created a support. The market makers had to go in and balance this, and if you saw this, there was a dip buy opportunity around 145. Of course, you would have gotten smoked if you did here, but right as to the end of the week, you had a massive pump. Now remember, this guy got 816 expiration, and look what happened. They closed the stock above 145 by 8/16, expiring him out of the money and thus worthless. This order was too big. He created his own support level in the market. And if you didn't understand something like the rotations, or you didn't have a clue and monitor the option flow or the options market, you would have no idea what was going on. You wouldn't have seen this imbalance. You would have kept maybe shorting this. Maybe the CVX here was your favorite stock to short because you were emotionally attached to it. Maybe you won early on in your trading career in it, and you felt like you were better at trading the stock. But if you never knew that this one order came in behind the scenes, this changed the future of the stock. So understanding how the market works is ultimately what's going to make you profitable, and it's ultimately the more effective perspective. I'm not here to tell you that patterns are worthless. There are scenarios where bear flags and bull flags are necessary. There are scenarios where other patterns can be used to your advantage. But what I'm saying is that this perspective is not effective of pointing and trading how the market looks rather than understanding what's going on behind the scenes. What are the factors that will never change no matter what car or market condition rolls into my shop? So what is better than all this trading patterns and RSI and indicator things? What is better than this, Raider? Well, like I said, my mentors taught me a perspective. They taught me a complete way, a system of looking at the markets. Just like a system, there's fail-safes. When one thing starts to not analyze the markets properly, I can always shift into the other boxes to find a problem solution, to find what fixes that car that rolls into my shop, to find what fixes that market condition and breaks it down for me to understand and execute on. My mentors taught me a perspective known as market mechanics. And market mechanics consists of 4 main tools that I use within my arsenal to analyze the markets through. Majority of them are through technicals, seasonals, rotations, and options flow. And you might be wondering, well, Raider, aren't patterns technical theory? Yes, but the technicals that I reference are nothing in comparison to patterns. They rely more on liquidity loss, understanding what areas of the chart can actually get a start moving and where is the best risk to reward geographically. Under the technical theory, you can see things like my charts here that have the expected ranges. These 2 lines are where the markets are likely to close in between with well over a 70% accuracy. How do we know that accuracy? Well, it's just based off normal distribution, and it's also made by the options market. The options market is one of the most predictive markets in the world, and they give you valuable information like that. Same thing with the market hedge range. These are where the market makers are hedging to in case the expected range gets broken. Additionally, I draw things like golden zones. This is where the markets are likely to pivot throughout the week and make a decision down or up. It's not likely to chop off of that area, and you can see each time that we tag this area, there was a very clear and convincing directional move. Whereas when you settle down into these lower supports, it was very choppy. No patterns, no indicators, just understanding what are the expectations of the market and what levels are in play. The next perspective is a seasonal perspective. On the RADER report, I have built this tool where you can see the seasonality for any stock that you choose, really, that has a seasonality. Right here, the overall market SPY over the last 10 years, you typically see some sort of top in late July or early August. And who could have been surprised when the markets this August started to come up to a high? And guess when it was? It was late July, early August that we saw a shorting opportunity in the markets, that the better risk to reward trade was likely down given the bearish seasonals. The expectations of the market were to sell. Selling pressure was the dominant theory, and that the downside trade was the one that was more in play. These set expectations for the market. It doesn't matter if you see a double bottom on a chart. If it has a bad seasonal like SPY did, you shouldn't treat that as a double bottom. You should treat it as a level that is likely to be broken, and that the downside trade is the better one, even if you do see a bounce off that low. And that maybe not trading that until that downside opportunity presents itself is ultimately the higher win percentage trade. The next one we kind of hinted on was rotations. Rotations is understanding how the markets actually rotate money between different sectors, stocks, and what kind of information that gives us. Remember when that triple tops formed on XLP earlier in this video? Well, this is what the rotations looked like during that. Well, first of all of the defensives and value sectors are improving relative to SPY in performance, which means they're starting to outperform the overall markets. Do you want to short the defensive stocks in a defensive rotation? Money is coming out of growth. They're selling technology and putting it into defensives. And whenever you see an into defensives and out of growth, the better short trade is actually in growth. That's what gets sold off the hardest. And if we look at that same time period on a different growth stock like semiconductors, this is SMCI on that June 27th, you saw these were the better short trades, not your XLP. Again, understanding how the markets work. Just because you see a pattern does not mean that that pattern is the one that will solve the problem. You're given a market condition, and if you understand how to read the mechanics, how the markets actually work, you will be able to diagnose it and understand ultimately what you need to do to fix it and become profitable. You can see that did XLP start to go down here? Yes, but ultimately the defensives were the better trade, and you can see that these just went opposite directions of each other. Understanding the relationship between how money moves in the market between different sectors, stocks, and industries is what ultimately got me to that decision. And you can do this in real time. On the RADER report, I post the monthly report right here. This was for June 28th when that triple top was forming. I was comparing the relative strength of these sectors and noticed that after the quad witching rotation, they were actually favoring defensives more than anything else. You can see here, the defensive rotation was in full swing. And majority of the trades that worked out for me that month were generally energy, defensive, and value names. One of my biggest scores was XLU in the month of June. And what do you know, to the downside that month, I had SMCI, the stock I just showed you collapsed while all the other defensives value pumped. To finish out this video and show you how powerful a market mechanics perspective is versus, let's say, a pattern finding one, I'm going to be showing you guys how I find trades live. I have not scanned the markets as of tonight, and I'm going to find every opportunity I can for tomorrow's open. So let's walk you through how I would do it and find a trade. So the first place I like to start are the rotations and also just understanding relative performance in the market. Because if I can spot what is doing super well following a major event, then I can kind of pin down what I need to actually look for when I go look at other things like option flow. So given that NVIDIA earnings were on the 28th, what I'm going to do is I'm going to compare all the sectors' performance from the 28th till now, and we can kind of get a good idea of what's going on. And you can see based on the rotations, it seems like a lot of these names like clean energy, XOP, of course, the oil energies, gold, these are all kind of defensive, as well as this is interesting, software right here. So this is doing really well. So maybe playing a continuation in some of these, and then you can see a lot of the defensive and value, and of course at the bottom growth. So if I'm going to take any sort of shorts, it's looking like it's going to be somewhere in the tech or semiconductors. So again, these are the sectors and the industries. Industries being smaller kind of subcategories like sectors. But these right here, the reason you want to see what performance they're doing, again, the reason I took it from NVIDIA earnings is because that's when you saw new money starting to flow into the market. That was such an anticipated earnings. We saw new money start to flow in, and I want to kind of catch these trends early as they progress. So just taking some notes of some of the themes, like, hey, softwares may be long, energy, oil, this kind of stuff. We're going to be watching those longs, maybe even value, banks, industrials, these type of names. And it maybe even seems like rate sensitive, small caps, right? The regional banks and IBB, of course, being a lot of biotech names. And of course, technology and semiconductors, these kind of guys short. So I'm going to keep those ideas in my head. And what we're going to go do next is actually look at the option flow and try to translate, see if some of these themes are matching up with some of the orders. So when I'm scanning through option flow, again, if you guys haven't seen a lot of my videos on this channel, what I'm looking for are orders that can create some sort of reaction in the market. I have set criteria that I have. 99% of flow is worthless. And even a lot of the flow you'll see me with the criteria scan for, majority of it is a pass. Now this right here is pretty interesting. Check this out. So this right here, okay, cool. So there's more than one order here. So this order was spammed from 1220. This is likely the same trader, 9-6 expiration, same strike, and same idea here. Notice how he kept spamming these puts. He put around 1, 2, 3, 4, count that as 500,000 on this trade here. And the way he's spamming this right here, it might be a little dangerous for him because of how much he's spamming it. It could be that this ends up actually being a bullish trade, even though he's spamming puts. Regardless, I think it's healthy to see some sort of bounce. So check this out right here. So this guy got the 27.75 strike. So he's right up here. He was spamming puts right here. So as you saw the market start to drop against it, he's now in the money. So the incentive would be that by next week, because he got the 9-6 expiration, that it makes sense that we see some sort of reversal against him. And so when we see that reversal against him, that's when we can reevaluate if he's actually worth following. But I think for right now, we can expect, especially aligning with that software long theory, that we can actually translate to a long trade in CrowdStrike. So I'm going to look at this. I'm going to go, okay, what is the better long? CrowdStrike, which of the softwares? And it seems CrowdStrike is probably the best one. This one has been the historically stronger one. So I'm actually going to take this one. So this is a trade idea right here, is that play the continuation in CrowdStrike to the upside. We can see the after hours here. It is starting to be, it's flat. We'll see by open. But this right here, we need to set some parameters now. Now that we have a reason that validates the technical analysis, now that we have a reason to verify why we should look at this technical analysis, why we should look at this chart over others, now we can go and chart it out. So again, this is a super weak close. You don't want to see this. It did not eat up this entirety of this candle. So I would say any gap up, you want to start to long right below this. So around 27,639. If you see gap up over or breach of that, I would go long, targeting a new high at 28.85. And then since he got next week's contracts, I would eventually go for that kind of 30% gap fill, which would be right around 288 or 290. So this is my trade right here. I added some conditions so that I do increase the probability of this trade going in my favor if it does trigger. So I said it needs a gap up. And the reason for that is if they're going to show any sort of strength, this right here is a lot of weakness. To counteract that, we need some sort of gap up. The gap up doesn't need to be much. It just needs to be a little bit. And then let's say we gap up to here. As long as that gap up plus that candle comes into that level, I'll take a long. The reason you want the gap up, it incentivizes more buying pressure. It invalidates a lot of the selling pressure from the previous day. So this is super important. You need a gap above or into this golden zone. Right under it, push. But as long as both the candle and the gap break this level, that's an entry and you will be targeting that new high there. And again, why does this trade make sense? I always start outside of the price charts with an idea to validate the price action that I'm looking at. I always need a reason to validate why this price action would make sense, because at any given point in the market, there are thousands of head and shoulders, thousands of bull flags, thousands of bear flags. I need to have information that narrows that down and validates why this stock I'm looking at has edge, why this price action setup has edge over all the other setups. Only a fraction of them actually work out. So because IGV, which is of course softwares, which is of course crowd, we already had that kind of heads up that, hey, if we're going to play a continuation and the market's higher, we can expect that, this is going to be the outperformer, the software names, because the leaders get the biggest rotations on a continuation. And I mean, you can also see it right here with the RRG chart tool. If I just type in IGV, you can see right here, boom, IGV is miles ahead of a lot of this stuff. It's outperforming by a significant amount. So if the markets were to go to maybe an all-time high on Friday tomorrow or something like that, this will likely get the biggest rally with that derivative support, with that option also supporting that slingshot. The markets do not want to necessarily put that order in the money given where he placed it. So it doesn't look like there was much, not much. Nope. There wasn't much today. So what I'm going to do next is I'm going to go through and I'm going to look at historical data. So what I'm going to look at is through Monday through Friday, since I missed quite a bit of days here. So you see me going through this flow right now, and I'm skipping by all of this SMCI. While it is a semiconductor and while it is a bunch of calls, it doesn't really mean anything to me because, again, all these were earnings related. It does not matter. But this, on the other hand, this is real interesting, this order. This order right here, although not related, both of these orders are necessarily related, they are heavily betting on some sort of expansion in the market. So check this out right here. If we go and look at KSS, this is Kohl's. Now, when we're looking at Kohl's, we have to understand what Kohl's is. It's a retail name. So if we go and we go, okay, well, let's go find some more information on this, right? I'm going to go to my seasonal tool here on the RADER report, and I'm going to type in, we can look at XRT even. And what you'll actually notice here is that there is a seasonal advantage for retail names into the first 2 weeks of September. So kind of correlating these two things, that, hey, there's a positive seasonal, but also there's this option flow betting on expansion. I think we can go ahead and try to find a trade in this. Are betting on some sort of expansion. This is heavily beaten down. We are coming towards the low. And again, this is where technicals almost don't matter. You have to understand what is the kind of criteria, or what is the validation behind the price action. And right here, we have some sort of put for 9.6. It was on 8.28. So they place this right here, this put right around 20.94, which is all the way up here at the top. He is now in the money with only a week left. And this strong response today, you can see that Kohl's actually closed almost 1% up, while the markets closed down. So there is some significant relative strength here. So given that this put right here was kind of in the money, closed, it is a hedge, I am betting that this is actually going to see some sort of significant pop. Again, strong close today. What we're going to bet on is by next week some sort of rally. So if Kohl's decides to gap up tomorrow or anything like that, I'm going to set a basic trigger level right around 2020. 2020 will be my entry, just above that high where I want to see some sort of break. And so again, we're going to kind of demand some respect from it. We want to see it open flat or have some sort of gap up, and I'm going to long. Now, where is the best long for this? I'm going to be targeting a new high, of course, somewhere around here, maybe all the way somewhere around here. But this right here is a kind of an exceptional trade, right? You have a put. He placed this at 20.94. He is up. He is up in the green right now. He's in the money. And so the incentive for the market maker with this criteria of an order, 3,000 cons, 6, 180 for only a week, this is kind of a big deal. And given the relative strength of Kohl's, the people who are shorting this, I feel, will be punished. And so I think there's a day trade in this to trade it long. So we have CrowdStrike long, and we also have KSS long. I know I screenshotted the call. You guys can ignore this. This isn't important. But what I would say for this Friday, of course, being August 30th, I would long this. So again, anything over 2020 is my entry. Okay, so this one right here is actually interesting as well. So this is FCX. So check this out. This is, I believe they are a gold miner. They are definitely defensive and industrial. And if we remember back from that chart that we looked at here, that GDX, gold miners, these guys were doing really well. And this one looks like it's kind of lagging a little bit behind. So what's interesting about this one is this is actually a gold miner, FCX. And so we know that these gold miners are in the attention of the market because of their, since NVIDIA's earnings, again, the last liquidity event. That's why I'm comparing that time frame of sector performance. Since that last major liquidity event, we were seeing a lot of money flow into these gold miners and things like that. The reason this order is interesting is because it's actually what's called a discount trade, where it's not so much we're looking for a mechanical response like from the market makers trying to rebalance, but we're actually trying to find a trade in the same direction. So what you often see whenever you see this order placed is you'll see it like instantly get discounted. And what I mean by that is the market makers will start to sell it off. The sooner they sell it off, the actual higher win rate it has of actually working. So you can see that as soon as he placed this trade on the 28th, it's even rejected off it again today. So this is definitely a discount trade. And what you want to try to do with this order is you want to try and catch it at a lower price once the market makers, because what the market makers will do is if they see this order and they're like, ah, shit, I got to go balance this out real quick. They'll sell shares, they'll drop it down, put this guy under a lot of pressure, and then they'll actually rally it back up. So if we see him instantly get clapped, that's actually a good sign. Now, FCX, the question now becomes, we have to be intelligent. If FCX is a gold miner, we have to think about other gold miners. GDX is the ETF for it, but also I'm familiar with the stock, NEM, which is one of the largest, if not the largest gold producer in the world, or miner at least. And this one is much stronger, relatively speaking. This one is absolutely ripping. So is this actually going to be the one to catch, or are they trying to catch some sort of second rotation on these beaten down gold miners? So I'm actually going to favor NEM as the continuation trade. But if this gets discounted, which it should maybe tomorrow, and then offer a trade in it next week, we can take a trade on this one as well. So the possible areas where this can get discounted is right here. You want to see some sort of, drop down in this area, a slowdown, and then maybe a gap up off of that to trigger your long position. Essentially, as well, if this does flush down, what you'll want to do is you want to take 30% of this gap. Just do a quick little liquidity rule. That 30% into a gap, as long as it hasn't been pushed in too heavy, is going to be a liquidity zone. So 1.32, We can just do 1.32 divided by 3, and you get 44. So what you'll do is you'll take 44 right around there. And you can see this area is going to be your general area for long. So these two zones are going to be what I'm going to look for to buy the dip in. And again, whether this is to time another trade long in NEM or FCX, we'll have to see. But I'm anticipating this to be a bullish miners trade. And that's pretty much it seems, for the option flow. Again, I'm not going to take too much weight into these flow that came in before NVIDIA earnings because they don't really mean a lot. So I'm not going to pay attention to those. But this right here, we found 3 trades. So let's see if we can find any other ones. So here's a trade that I actually found. Now, this is, of course, I map out on the RADER report, all these indices. But this right here is XLU. This is utilities. And, you know, as a trader, I have to map out a lot of these ideas we've had are bullish on defensives and things like that. But we had CrowdStrike, which is growth. And this right here is an interesting trade because if the markets continue to tank tomorrow, you'll actually see a lot of strength come back into these defensives, especially XLU. Look at that strength off of that zone right there, boom, into the high here. So this is a simple, a theory play, right? I always say that I want a reason behind why I'm looking at this price action. And the reason for this is, of course, the rotations, that if we do see a drop continuation tomorrow, in the overall markets, in SPY, we continue to see a sell-off, you should see a big pump in this XLU in defensives. So I like XLU. I think that one's going to be the go-to for tomorrow to play the continuation. I think it has plenty of upside as we start to near that all-time high level. So I think that's going to be the ultimate goal for this. So, I mean, heck, even 9-6 contracts, play the big rally, get a nice big fat candle tomorrow. And this is entry, so as long as you open flat or gap up tomorrow, it's going to be entry. I'm just going to grab some 9-6 calls. And as far as trades to the downside, I found one idea, and it was Microsoft. Now, you might go, well, wait, Raider, aren't you just looking at price action? Aren't you just doing what we told you not to? No. So there is a theory behind why I'm looking at this. Because SPY, again, we have to create scenarios both for the upside and the downside. That's literally why on the RADER report, I have a thesis, a bearish thesis, where I discuss the bearish opportunities, but also the bullish opportunities, which is always found in, you know, the bullish thesis, which I always outline all the way up here. But what's unique about this order right here is that, what's unique about this idea is that if the markets are coming near a top, right, and they are, and we can see this on a rotational perspective as well, that, you know, on the daily chart here, if we throw this on, you'll see that there's a lot of rotation out of growth. As we come up towards the top of a market, if this is the top, then you will see mega caps get sold off the hardest. That is basic market 101 fundamentals, that when you come to a top of a market, the mega caps, the big winners, the big rotations that were, you know, the big favorites of the last rally, they get sold off first. So you can expect mega caps to slump. And this is an idea, again, relative performance. If you look at things like Apple right now, this had a huge gap up. That's green, okay, so that's a favorite of the rotation. But you can also see Microsoft, this one slumped a little behind. So I'm actually going to target the mega cap short. I think these are going to be the bigger ones. I think Microsoft will be a victim tomorrow if things heat up. So any downside momentum tomorrow, any gap down, I think I'll target some shorts on mega caps like Microsoft. That's all I have for today's video, guys. If you enjoyed this type of content, deep market analysis into the inner workings of the market, you guys are more than welcome to stick around. Again, my name is Raider. My concepts aren't for everyone. I do talk about quite advanced things, but if that's your thing, you're in the right place. If you guys want to sign up for the RADER report, this has been my life's work. I just bought recently an API, which gives me live data, and I'm going to be integrating that within the terminal for a ridiculously low price. You can see all my trades, charts, game plans professionally laid out in there, published every Sunday before the market opens so you guys can see my trades. Have a great day, guys. Bye-bye.
I never switch sides, like even when I die, I'm a ride for the squad, let ties in the hearse. I've been on the vibe, kinda hard to describe. I'm in between, I'm good and it's fine, but I'm